So renowned economist Harry Dent argues that the collapse of the everything bubble will generate severe debt deflation unlike anything we have ever seen before. He believes that this will be so severe that the ensuing liquidity crisis and deflationary bust will see gold collapse to as low as $700 an ounce. Today we examine this argument, so let's dive on in. First up, I've got to say that I do agree with Harry Dent's overview that we will experience further asset price deflation, stock and housing market crashes. His model for the continuation of this crisis looks like this graph, where we've got the Nasdaq stock index and we can see an eventual low of 1,000 by autumn 2022. With such an outlook, which would cause all sorts of liquidity problems, this would act as a significant drag on the price of gold, as gold would be sold and profits would be taken to cover losses elsewhere. Now, before I really examine Dent's arguments here, it's worth just reminding ourselves of the everything bubble that we now face and what it actually includes. Now, all this house of cards required was some sort of catalyst, but what we got was the complete extermination of economic output via COVID-19 as that spread around the world and economies went into lockdown. So if we look here, we did see a significant collapse in the gold price in 2008, where it quickly lost 30% of its value. So what are the chances of this happening again, to the extent that gold goes to 950 or even 700 as Dent suggests? Well, I think pretty low indeed. If we consider what actually happened between 2001 and 2008, when gold rose from around $250 to $1,000 an ounce, this upward trend attracted a lot of momentum investors who later faced margin calls as stocks collapsed in the early autumn of 2008. They took their gold profits and ran. We saw something similar back in late February and early March of this year as gold retreated back to 1450 or so. Now, from what I've seen and read of Harry Dent's arguments, he seems to ignore the actions of the Fed and government in his gold thesis. It's almost as if the economy is allowed to fully collapse and enter a complete deflationary downward spiral. This would undoubtedly be enormously damaging for the whole economy. Now, in 2008, the QE program was targeted at recapitalizing the banking sector to allow them to actually lend credit to act to support wider asset prices. The intention was to ensure that the financial system could still function and provide lending capacity to the real economy, and that it didn't blow up altogether. The Fed's actions also had the crucial impact of reducing the strength of the dollar internationally. Consequently, the S&P 500 bottomed out just months after the Fed's intervention. The 2008 recapitalization of the banks and the 2020 market support that has been used so far is actually not altogether in gold's favor. These bailouts encourage large institutions and hedge funds to actually take greater risk as the Fed promotes this moral hazard, as the FT has commented, that is, taking unnecessary risks because you know there's a bailout coming. Consequently, their trades will then focus on short-term, riskier calls on stocks rather than trend-following gold. In essence, the opportunity cost of holding gold is far greater when the Fed acts to support market crashes and short-term profits can be realized. For instance, Citibank shares surged 58% following announcements of bailouts from Hank Paulson in 2008, and we've seen something very similar with Boeing shares in recent weeks. Sven Heinrich recently tweeted that none of the Fed's actions have boosted the economy, they've boosted the stock market. But the key problem area in 2008 was in the financial sector. This time it's in corporate debt. The banking sector has been somewhat buffered thanks to the growing percentage of non-bank lending that has helped drive this market. Crucially, what is 100% good for the gold price is a new form of QE taking place that will have far more impetus on the price of gold. It literally is monetary Armageddon, and I'm sorry to say that the UK is leading the world in pioneering this new format of reckless quantitative easing that other nations around the world are almost sure to imitate. We know that national debt is a real problem and tax revenues will fall off a cliff while spending on welfare and healthcare has had to soar. So what are governments globally going to do to actually finance current expenditure? It's direct debt and monetisation via quantitative easing. This is the method by which central banks and governments intend to truly reinflate our economies. We're going to see modern monetary theory, helicopter money, and this is so much more bullish for gold. It does not support asset prices, just covers the government expenditure commitments, and thus, unlike the traditional quantitative easing approach, the money doesn't get stuck in financial assets. This approach is likely to speed up the velocity and circulation throughout the economy and then ignite that inflation spark that governments and central banks desperately need. If this approach succeeds in generating inflation, we will face a prolonged period of stagflation. No growth, just strong inflation, helping to erode the real value of government debts. Meanwhile, gold price rises will play catch up to the ballooning central bank balance sheets as we've examined in this video. But then there's also the whole dollar funding issue. With a current monetary base of $3.4 trillion and $90 trillion owed globally, there just are not enough dollars to go around the world. This is what Brent Johnson was referring to with regard to his dollar milkshake theory, and thus there is a desperate need for the Fed to continue to intervene to supply dollars and weaken the currency globally as they had to do in 2009. This is another issue I haven't seen Dent examine. The weaker the dollar is internationally, the higher gold goes. If you're not holding US dollars, what other currency are you going to actually want to hold? You can't go for the yen with Japan mired in debt and stagnating, while the Eurozone faced a horrific banking crisis and then Britain is pioneering debt monetisation. A dollar correction is going to be necessary at some point, and this is so bullish for these assets I keep talking about: gold, silver and Bitcoin. But what about if the authorities fail to actually ignite the velocity of circulation and inflation doesn't stir? How does gold really perform in a deflationary period? Well, this chart shows gold's nominal price performance over time with recessionary periods marked in grey. But the truth is that we don't really have a huge amount of information on this. Jim Rickards will always refer to the Great Depression, where gold was revalued from $20 an ounce to $35. But the gold price had been fixed at just above $20 from 1880 under the enormously successful classical gold standard. But Roosevelt understood the need to reinflate the economy in 1933, undertaking a re-evaluation of gold and an effective devaluation of the dollar. This reminds me of that old Mark Twain quote: "History doesn't repeat itself, but it sure does rhyme." But what we know for sure this time is that currency creation is going into overdrive. And while we can expect deflation first, our debt-based system requires inflation. And our authorities will do all they can to generate this. We must also remember that unlike in 2008, globally central bank demand for gold is so much higher, and this diminishes the available supply for investment. This will be reinforced by the whole issue of supply constraints as a result of mines having to actually put down operations and the transportation difficulties as a result of COVID-19. Interestingly, as Roy Seabag points out, the Canadian government has just rebalanced gold mines as essential businesses. Why would they do that when so many more important businesses are considered non-essential? In fact, looking at this excellent graph from Luc ten Haave of the Barron's Gold Mining Index, the gold price has the potential to run a lot further. We can see the price from 1996 to 2011 in blue and the period 2011 to present in orange. I don't ever remember being so bullish and seeing so much information which reinforces my perspective as I do now. So I, like many of you, I'm sure, disagree with Dent's outlook. I echo Jan Gold's sentiment in this tweet that I think gold's performance is remarkable given the deflationary forces at work now. Wonder what will happen when inflation kicks in. But until velocity of circulation rises, we won't see that inflation impetus. To understand this, check out this video which explores whether hyperinflation could actually be on the horizon, or alternatively, how gold could go to $5,000 or beyond here. Thanks ever so much for watching. Do make sure you hit that like button, drop me a comment, let me know what you think of Dent's remarks here, and make sure you've hit that subscribe button. I look forward to seeing you next time. Bye bye.